It can take you 3 to 18 months to fix your credit up properly to buy a property or to make a major purchase. So it's really important to start as soon as possible to fix your credit up. Today's topic is how credit affects refinance rates. So this week I had someone come to do a refinance, and the first thing is when you're getting a refinance in the current 2020 market, if you do a standard rate and term refinance, which means you're not taking any cash out on your refinance, you just have a $100,000 loan, you're doing a refinance and you are going to keep the $100,000, but you just want to lower interest rate or extend it to a 30-year period. If you're doing that, there's not a lot of fees associated. So, but if you are taking cash out, there is a lot of fees. So I just want you guys to be aware that that is the situation right now. Now, to the point, if someone came in with, say, an 800 credit score, between a 750 and 800, it doesn't make much difference on your actual rate. Now, what I want people to really realize is it's not the rate that's technically changing when you're getting a loan. You can look at it as two ways. You can look at it as the rate changing, or you can look at it as the fees associated to get that rate changing. Because when you have a low interest rate, it's a very low risk loan. But if someone that has a high risk, high probability of not paying back the loan, they actually have to pay more money to get that lower interest loan or that lower risk loan. So if you have between a 750 and 800, it doesn't really make much difference on the rate in your points. But if you start going below 750, between 720 and 750, you actually have to pay more points to get the same rate. So we're gonna say roughly, in the example I was looking at today, for say, it was a single family refinance, it was about $1,000 more. And then between 720 and 700, it was another 1,000. 680 to 700, another 1,000. And then 650 to 680, another $1,000. So you're looking at about a $5,000 difference on your refinance for the same rate. So the person was looking at a 2.99 rate. So between a 750 credit score and a 650 credit score, it was almost a $5,000 difference that they would have to pay extra in points to get the rate, the 2.99 rate. So you can see that your credit has big implications on how much you're going to pay for a mortgage financing. The same way, credit has a large effects to your credit score. With your credit score actually has significant effects towards your credit card interest rate, your car interest rate, not just approval rate. The credit doesn't, unless your credit's very bad, like it's under 650, it doesn't really come into play to where it says an approve or a decline. What the issue actually comes to is how much money you have to pay to get this loan. So, and that same thing with your car insurance is affected by your credit. Your health insurance can sometimes be affected by your credit. A lot of factors can be affected by your credit. So it's really important to have credit in good standing. Now, normally it can take you 3 to 18 months to fix your credit up properly to buy a property or to make a major purchase. So it's really important to start as soon as possible to fix your credit up. So I thought that was very important to let you guys know that. Make sure you got your credit right so you can get the best deal possible, because you don't want to have to pay extra points if you don't have to when you're buying a loan, when you're buying a loan, buying a property. Because what you're actually doing, you're buying a property, but the points you're paying, you're actually buying a loan as well. Now that's kind of hard to click, because you're thinking, oh, I'm buying a property and I'm getting a loan to buy the property. Well, you're actually buying the loan and then you're using that loan to buy the property. So it's kind of how things work in the finance world. So that's my world. So let's go to the questions, guys, all right? So Mike says, I ignored my credit score for a while. Big mistakes. Yeah, definitely. You do not want to ignore anything. I saw this on a plumber's shirt. He said, don't ignore your plumbing leak. it won't go away. It only gets worse. And it's very true with your credit and your finances in order, that it doesn't ever automatically get better. You have to work to make it better. T Nice says, excellent point to your buying the loan and using that to buy the property. Yeah, that's how the finance world really works. And it's, when you look at the intricacies of how a loan works, it's crazy. It's awesome and crazy at the same time when you can learn to respect how a loans really work. So Mike Will Made It says 10, 15, or 30-year fixed rate. I prefer personally a 30-year fixed rate loan, because I feel that we're gonna have significant devaluation of our currency, and how we're really gonna see it is significant asset appreciation. So I don't see the point of paying back the loan faster, because the asset values are gonna go up so fast that comparative to how fast the asset value is gonna go up, our loans that we owe are gonna be insignificant. So it's better that you say invest $100,000 into another property, and by making a smart purchase, and let that asset go up in value, than paying down the $100,000 mortgage. In reality, you're saving what, 3% a year on a 3% loan, where that asset, if you make a smart decision, you should be able to gain about 7% a year. So you're gonna make that spread, and the money you pay, the longer you wait to pay that money, the less the purchasing power of that dollar has. Rob says, I'm trying to earn credit because I currently don't have any at all. I've been looking at using a credit card, but I'm not sure how I feel that. Any suggestions? So yes, you should have 2 to 3 credit cards, probably 3 credit cards. This way, you're gonna be able to build your credit the fastest. Remember, every credit source you have, credit card, mortgage, car loan, imagine each credit that you have is a person saying something good about you. Every time you make a payment, that is someone saying something good about you. So if you only have 1 credit card, in 12 months, you only have 12 good comments on your credit score. But if you have 3 credit cards, you have 3 good comments per month. You're having 36 good comments on your credit score every year, if you're paying them on time and keeping a low balance. So remember that. It's not less cards is better. It's actually more is better, as long as you're paying them down and you're make sure you're maintaining them. What's your take on a low down payment, let's say 3% on an $80,000 loan? So if you get loans under $100,000, and actually loans under $200,000, the rates and points are a lot more. So it's actually cheaper to get to purchase a loan that is around at least $200,000. So what is my thought on that? I don't have an issue with any type of loan. There's times where I would get a hard money loan and pay 9% interest for that loan. And I can get that loan with only 10% down because I'm gonna do a fix and flip. The loan itself doesn't matter. The loan is a tool. Remember that, guys. The loan is a tool. So some people were sending me videos and asking my opinion, like, what do you think of an FHA 3.5% down? What do you think of house hacking? Remember, guys, these are tools. It's like someone coming and telling you, well, is a hammer useful? Well, yeah, a hammer is useful in its proper use. You're not gonna use a hammer to cut a piece of wood. You're gonna use a saw for that. So you're not gonna use a screwdriver to hammer in a nail. Everything has its purpose. So you can't just say flat, what do you think of a 3% $80,000 loan? What really matters is, what asset are you purchasing and what is the intent of that asset? If you're planning to fix and flip, then maybe if you can get this type of loan, that could be good, because it'll leave you more capital for you to be able to fix up the property and then sell it right away. Or to do a BRRRR method. So remember, the loan itself doesn't matter. What matters is the asset. Is the asset a good asset to purchase? And then, based off of how good that asset is to purchase, what is your goal with that property? And that will determine what type of financing you want to get. And yes, I do think buying a 4-family property, living on one side, house hacking it, fixing the property up, is a great way for you to make money. But if you are a professional and making a lot of money, that might not be worth it for you to fix it up. It might be worth it to pay someone else to fix it up. It might be worth it to pay a property manager to manage it. You can still live in the property. I would advise not to tell anybody that you're the owner, because they might be coming to you with all the problems. But just make sure that you manage things like you would manage any other business, that you let them know that, tell it to the property manager, it's their responsibility to manage these things.